You've heard this phrase 1,000 times, whispered in trading rooms, repeated in online forums, dropped casually into conversations like some universal law of nature. Yet very few traders ever stop to ask what it really means. They assume it refers to intelligence, special strategies, or some secret formula hidden behind layers of complexity. But the truth is far more uncomfortable and far more liberating. The 10% who make it understand the market in a way the remaining 90% never allow themselves to, not because they are more talented, but because they have trained themselves to think differently. When you step into the arena of trading, it's not the charts, the indicators, or the news that challenge you, it's you. The markets don't judge, punish, or reward. They simply reflect. They reflect every belief, every fear, every expectation, and every flaw that a trader brings with them. And for most, this reflection is too honest, too raw, too revealing. That is why the majority remain stuck repeating the same patterns, convinced that success is about predicting what the market will do next instead of shaping what they themselves bring to the market. The phrase "only 10% make it" is not a warning. It's an invitation to look inward instead of outward, to stop chasing the illusion of certainty and start cultivating the mindset that thrives in uncertainty. The ones who make it aren't searching for the perfect trade. They are building the mental environment that allows them to execute their edge consistently, without hesitation, without fear, and without the need to control what cannot be controlled. Think about how most traders approach the market. They believe they are here to win, yet everything in their behavior reflects the fear of losing. They want freedom, yet their minds are chained to expectations. They seek certainty, but they enter a world defined by randomness. This inner conflict creates emotional friction, hesitation, impulsiveness, revenge trading, overconfidence after a win, self-doubt after a loss. It's not the market defeating them, it's the unresolved battle happening within themselves. The 10% have learned to neutralize this battle. They don't eliminate fear, they understand it. They don't avoid uncertainty, they accept it. They don't seek to control the market, they focus on controlling the decisions they make within it. This mindset shift transforms every part of their trading experience. Instead of imposing their beliefs on the market, they let the market reveal its intentions. Instead of trying to be right, they concentrate on executing flawlessly. Instead of needing outcomes, they focus on the process. What separates the 10% is not brilliance, it is alignment. Alignment between what they think, what they feel, and what they do. When these three elements move in the same direction, trading becomes a game of probabilities instead of emotions. Opportunities become clearer. Stress fades. Decisions become simple. And consistency, something the 90% chase endlessly, begins to emerge naturally. Mastering your internal environment before engaging with the market is the foundational shift that separates struggling traders from consistently profitable ones. Most traders believe their challenges originate from the market itself, its unpredictability, its volatility, its unexpected reversals, the complexity of price action, or the belief that someone out there knows more, sees more, and therefore has an advantage. Yet the reality is that every technical challenge a trader identifies is secondary to the psychological challenges happening within them. The internal environment you carry into every trade becomes the lens through which you interpret information, the filter that determines your reactions, and the force that drives your decisions long before the market does anything at all. Your internal environment includes your beliefs, expectations, fears, emotional triggers, past experiences, and the mental habits you've developed over years of interacting with uncertainty. When you watch price move on a chart, you aren't just seeing candles or bars, you're seeing your interpretation of them shaped by everything inside you. This is why two traders can look at the exact same chart and make completely opposite decisions, both believing they are doing the right thing. The difference isn't the chart, it's the internal structure each trader brings with them. To master your internal environment, you first have to become aware of it. Most traders operate on mental autopilot. They place trades driven by impulses they don't fully understand, act out patterns they don't realize they're repeating, and react emotionally to movements that shouldn't have any emotional impact at all. But because trading exposes you to freedom, the freedom to act, choose, enter, exit, risk, and commit, it also exposes every internal flaw you carry. Any unresolved fear will show up as hesitation or premature exits. Any hidden need to validate yourself will show up as oversized positions or revenge trading. Any deficit in discipline will become magnified at the exact moments you need discipline most. The internal environment of a consistently successful trader is structured in a way that supports neutral, objective decision-making. They understand that the market has unlimited potential to create stress for those who approach it without mental structure. Without mastering your internal environment, the market becomes a psychological battlefield where uncertainty triggers fear, randomness triggers confusion, and temporary outcomes trigger emotional swings. The result is a trading experience defined by exhaustion, frustration, and an inability to trust either oneself or the process. The first step toward mastering this internal space is learning to separate what you want from what the market is actually offering. Most new or struggling traders enter the market carrying an emotional need, a need to win, a need to be right, a need to recover a loss, a need to feel in control, a need to feel rewarded quickly. These emotional needs distort perception. Suddenly, every candle seems significant, every pullback feels personal, every winning streak creates overconfidence, and every losing streak creates self-doubt. When internal needs replace objective analysis, the market becomes a mirror reflecting your internal turmoil rather than offering you opportunities. Mastering your internal environment means eliminating these needs, or at least neutralizing them, so they no longer influence your decisions. You structure your mind around probabilities instead of predictions. You learn to accept the fact that any trade can win, any trade can lose, and the outcome of the current trade has no bearing on your identity, capability, or future possibilities. This acceptance frees you. It removes the emotional weight from individual outcomes and allows you to engage with the market without the psychological baggage that drains energy and clarity. A stable internal environment also requires detaching from expectations. Expectations are mental anchors, rigid beliefs about what the market should do, what a setup must lead to, or how long a trend ought to continue. Expectations create emotional tension the moment the market does something else. The mind becomes resistant to new information, unable to adapt to changing conditions, and slow to accept reality. When you expect the market to behave in a certain way, you stop seeing what it is actually doing. This disconnect between expectation and reality is the source of frustration, confusion, and impulsive decision-making. Mastering your internal environment means replacing expectations with openness. You observe without demanding. You react without attachment. You decide without emotional distortion. You accept whatever the market reveals moment by moment instead of forcing your narrative onto it. This mental flexibility is what allows the best traders to flow with the market instead of fighting it. Another critical part of mastering your internal environment is managing your emotional response to risk. Risk triggers instinctive reactions: fear, excitement, greed, anxiety, impatience. These reactions are natural, but they become destructive when you allow them to govern your decisions. To master your internal space, you must create a mental relationship with risk that feels neutral. This means defining risk clearly, choosing position sizes that don't evoke emotional discomfort, and acknowledging that risk is not something to eliminate, but something to integrate into your process. When your internal environment is aligned with the realities of trading, you stop reacting emotionally to losses. You stop overreacting to wins. You stop chasing trades out of fear of missing out. You stop exiting early because your mind cannot handle the movement of price against you. You stop altering your plan mid-trade because of sudden bursts of doubt or hope. Instead, you become a participant who acts deliberately, calmly, and consistently, regardless of the short-term noise. Mastery of your internal environment also involves building trust, not trust in the market, because the market is not designed to be predictable or trustworthy in the emotional sense. The trust must be placed in yourself, your rules, your process, your discipline, your ability to execute without interference from emotional impulses. Trust is built through repetition, structure, and emotional neutrality. When you know that you will follow your rules regardless of what you feel in the moment, you develop an internal stability that the market cannot shake. This internal mastery does not happen automatically. It is a deliberate construction of beliefs that support successful trading. You build beliefs around uncertainty, around probability, around responsibility, around neutrality, and around consistency. These beliefs form the psychological framework that holds your mindset steady even when the market moves unpredictably. Without this framework, you are vulnerable to every impulse, every sudden movement, every emotional reaction triggered by the possibility of gain or loss. To truly master your internal environment, you must commit to observing yourself with the same intensity you use to observe the market. You analyze your reactions, your recurring patterns, your triggers, your impulses, your habits. You adjust what needs to be adjusted, reinforce what needs to be strengthened, and eliminate what consistently undermines your performance. Through this process, you create a mental landscape where clarity replaces confusion, calm replaces chaos, and discipline replaces emotional drift. Detaching from outcomes and focusing only on executing your edge is the psychological core of consistent trading. Most traders believe they are operating from logic and analysis, but in reality, they are operating from outcome dependence, meaning their emotions, decisions, and confidence fluctuate based on whether a trade wins or loses. This outcome-focused mindset creates instability because every trade becomes a test of personal worth, intelligence, or capability. When your identity becomes entangled with the results of individual trades, the market gains power over your emotions and your judgment becomes compromised. Detaching from outcomes isn't about caring less, it's about reclaiming your clarity so you can perform consistently regardless of temporary results. Every outcome has emotional weight when you are attached to it. A winning trade inflates confidence, often leading to over-risking or breaking rules. A losing trade deflates confidence, creating hesitation, fear, or the impulse to recover quickly. This emotional roller coaster is the reason most traders never reach a stable state of mind. They are constantly oscillating between extremes: euphoria and anxiety, hope and regret, aggression and avoidance. These psychological swings distort decision-making because they shift your focus away from the present moment and pull you into the emotional residue of past outcomes or the fear of future ones. To detach from outcomes, you must first understand that any individual trade is statistically insignificant. Your edge plays out over a series of trades, not a single moment. A trader who relies on one trade to validate their strategy or skill is setting themselves up for emotional dependency. When you embrace the nature of probability, you stop seeking certainty where it doesn't exist. Instead of demanding that the market deliver a winning trade, you commit to executing your plan because you know the result of one trade has no bearing on the overall effectiveness of your edge. Focusing on executing your edge means shifting your attention from what you hope will happen to what you can control. You cannot control the outcome of a trade, but you can control how well you follow your rules, how accurately you identify your setups, how consistently you apply your risk management, and how disciplined you remain when the market moves unpredictably. Execution is a matter of process, not prediction. When you understand this deeply, the need to be right dissolves, and with it, the emotional pressure that distorts your decision-making. Most traders don't realize how much emotional energy they invest in outcomes. They watch price movement with anxiety, as though they could influence it by feeling strongly enough. They tie their sense of success to the immediate result, rather than the long-term consistency of their execution. This creates subconscious pressure, making them react impulsively, moving stops, cutting trades too early, chasing moves they missed, or adding to losing positions because the pain of accepting the current outcome is too great. These behaviors are symptoms of outcome attachment. Detaching from outcomes liberates you from these emotional traps. When you stop evaluating yourself based on whether the last trade won or lost, you reclaim the ability to evaluate yourself based on your behavior. Did you follow your rules? Did you manage your risk? Did you execute your plan without hesitation? These are the real metrics that determine success. When the mind stops obsessing over outcomes, clarity emerges. You no longer fear losing because you understand that losses are an inherent cost of doing business. You no longer feel euphoric after winning because you understand that a win doesn't guarantee anything about the next trade. To focus solely on executing your edge, you must adopt a mindset rooted in acceptance. Acceptance that the market is uncertain. Acceptance that losses are inevitable. Acceptance that you cannot know what will happen next. Acceptance that your edge is only effective when applied consistently. This acceptance changes the way you perceive every trade. Instead of asking yourself whether a trade will win, you begin asking whether it fits your plan. Instead of trying to control outcomes, you begin controlling your actions. Acceptance reduces emotional tension and allows the mind to operate from a place of neutrality rather than fear or hope. Detaching from outcomes also requires redefining what a good trade actually is. Most traders define a good trade as one that makes money, but this is a flawed definition. A good trade is one that is executed according to your rules, regardless of whether it results in profit or loss. When you redefine your metrics for success internally, your external results begin to stabilize. You stop chasing wins and start building consistency. You stop reacting emotionally and start acting deliberately. You stop viewing the market as something that grants or withholds rewards and start seeing it as a neutral environment where your job is simply to execute your edge. The psychological shift from outcome-focused to process-focused trading is transformative. You begin to experience trading with less emotional friction. You no longer feel the need to force trades when nothing is there. You no longer fear missing out because your focus is on quality, not quantity. You no longer fear drawdowns because you understand they are temporary phases within a larger statistical cycle. The mind becomes calmer, more centered, and more capable of recognizing opportunities without emotional distortion. Focusing on executing your edge also removes the illusion of control. Many traders believe that if they analyze more, think harder, or find the perfect strategy, they can somehow predict the market reliably. This illusion creates frustration and disappointment when the market behaves unexpectedly. When you detach from outcomes, you acknowledge that control is limited to execution. You stop trying to impose your expectations on the market and start responding to what the market actually presents. This shift restores mental balance and sharpens decision-making. Ultimately, detaching from outcomes creates psychological freedom. It allows you to act without fear of loss and without greed for gain. It allows you to follow your plan effortlessly because you aren't emotionally entangled with the result of any single decision. It allows your edge to unfold over time without interference from impulsive behavior or emotional reactions. And it transforms trading from an emotional battlefield into a structured process driven by discipline and clarity. Accepting uncertainty as the natural state of trading is one of the most transformative mental shifts a trader can make. Most people come into trading with an unconscious desire for predictability. They want the market to behave logically, to reward good analysis, to punish mistakes, to follow patterns reliably, and to produce outcomes that match the trader's expectations. This desire for certainty is deeply human. It makes us feel safe, grounded, and in control. But the market is not designed to satisfy this desire. Instead, it is a constantly shifting landscape shaped by millions of independent decisions, emotions, beliefs, and reactions. The moment you try to impose certainty on such an environment, you create psychological resistance, emotional friction, and mental tension that undermine your performance. Uncertainty is not just a part of trading, it is the essence of it. Every candle, every fluctuation, every breakout or reversal is a reflection of uncertainty. Even the most reliable setups have variations, anomalies, unexpected behaviors, and outcomes that fall outside historical patterns. When traders resist this uncertainty, they create a mental conflict between what the market is doing and what they want it to do. This conflict shows up as frustration when a perfect setup fails, hesitation when a good opportunity appears, fear when price moves unexpectedly, and disappointment when trades do not reach their targets. The mind becomes emotionally entangled with outcomes because it believes they should unfold in a particular way. This emotional entanglement clouds judgment, slows decision-making, and often results in costly mistakes. To accept uncertainty fully, you must shift your relationship with the market. Instead of trying to predict what will happen, you must focus on responding. Instead of seeking control, you must seek clarity. Instead of expecting consistency in price movement, you must build consistency in behavior. Accepting uncertainty does not mean surrendering. It means aligning your expectations with reality so you can navigate the market without psychological resistance. When you embrace uncertainty, you stop being surprised by normal market behavior. You stop feeling betrayed when a setup doesn't play out. You stop assuming something is wrong with your analysis or strategy just because a trade loses. You see each outcome as a natural expression of randomness within a probabilistic environment. One of the greatest obstacles traders face is the illusion of certainty. This illusion often comes from a few early wins, a well-defined pattern, or a strategy that seems to work flawlessly for a short period. The trader begins to believe they have figured out the market. They become attached to the idea that their analysis can consistently forecast price, but the market quickly teaches them otherwise. A sudden reversal, a news event, or a shift in momentum disrupts their expectations and the illusion collapses. What follows is emotional confusion. The trader begins doubting their method, their skills, and even their potential to succeed. But the issue was never the method or the skill. It was the illusion of certainty that placed unrealistic demands on the market. Accepting uncertainty means understanding that every trade outcome exists on a spectrum of possibilities, not guarantees. A setup may be high probability, but it is never guaranteed. A trend may be strong, but it can end abruptly. A breakout may look clean, but it can fail instantly. When you embrace this truth, you stop reacting emotionally to outcomes. You stop interpreting losses as personal failures. You stop needing the market to behave in predictable ways. Instead, you begin to operate with a mindset grounded in probabilities, where each trade is simply one event in a series with no emotional significance. This acceptance also influences the way you manage risk. When you acknowledge uncertainty, you understand the importance of protecting yourself from adverse outcomes. You size positions appropriately, place stops where they need to be, and avoid overexposure. You no longer feel tempted to gamble or over-leverage because you understand that even the best analysis can be blindsided by randomness. Risk becomes a calculated cost of participating in a probabilistic game, not a threat to your emotional stability. This shift in perspective reduces fear dramatically, because fear is often rooted in the attempt to avoid uncertainty rather than understanding. Accepting uncertainty also enhances your ability to remain present. When your mind is no longer consumed by predictions or expectations, you can observe the market without distortion. You see what is happening instead of what you want to happen. You recognize shifts in momentum, breaks in structure, or signs of strength and weakness without bias. Your analysis becomes clearer because it is not filtered through emotional attachments. This presence is what allows skilled traders to make fluid decisions, adapting to market conditions without hesitation or internal conflict. Another powerful effect of embracing uncertainty is emotional neutrality. When outcomes no longer dictate your emotional state, you become steady, calm, and focused. Wins don't inflate you with overconfidence, and losses don't deflate you with disappointment. You operate from balance rather than emotional extremes. This neutrality creates consistency in your decision-making because you are no longer reacting impulsively to the market's movement. You become less vulnerable to common psychological traps like revenge trading, FOMO, premature exits, or overconfidence-driven risk-taking. Instead, you approach each trade the same way, with discipline, clarity, and a focus on process. Accepting uncertainty does not mean ignoring patterns or giving up on edge-based trading. It means understanding that edges operate over time, not trade by trade. An edge is simply a statistical advantage, not a guarantee of immediate success. When you internalize this, you stop micromanaging individual trades. You stop obsessing over short-term results. You stop trying to force certainty into an inherently uncertain environment. This mental shift creates space for your edge to play out naturally. You become more patient, more consistent, and more aligned with the principles that drive long-term success. The most liberating aspect of embracing uncertainty is that it removes the psychological weight of needing to be right. Most traders subconsciously tie their self-worth to their win rate. They feel validated when they win and diminished when they lose. This creates tremendous pressure. But when you accept uncertainty, you detach your identity from outcomes. You understand that being right is irrelevant, and that what matters is following your plan. This detachment allows you to make decisions with clarity instead of ego. You no longer feel compelled to prove something through your trades. You simply execute your edge and let the probabilities unfold. Accepting uncertainty transforms trading from a stressful pursuit into a structured process. You stop fighting the market's nature and start flowing with it. You become comfortable with not knowing what will happen next because you no longer need to know. You trust your rules, your risk management, and your consistency. This trust becomes the foundation of confidence, not the fragile confidence built on winning streaks, but the stable confidence built on understanding reality and aligning your mindset with it. Eliminating the need to be right and prioritizing consistency is one of the deepest psychological transformations a trader must undergo. The need to be right is rooted in human nature. From early childhood, being right is associated with validation, intelligence, and success, while being wrong is associated with embarrassment, failure, or incompetence. This conditioning becomes so deeply embedded that most people enter trading without realizing how tightly their self-worth is tied to accuracy. But trading is not an environment that rewards the need to be right. In fact, it punishes it because the market does not care about your beliefs, your analysis, your expectations, or your ego. When your identity becomes attached to being right, every trade becomes a personal test, every loss becomes a psychological wound, and every mistake becomes a threat to your self-image. This internal pressure distorts your perception. When you need to be right, you stop seeing the market objectively. You begin seeking evidence that confirms your initial bias and ignoring information that challenges it. You hold losing trades longer than necessary because closing them would mean admitting you were wrong. You take profits too early because you want to lock in the feeling of being right. You add to losing positions because you're trying to force the market to validate your original idea. These actions have nothing to do with strategy. They are emotional responses driven by the ego's need to protect itself from the discomfort of being wrong. The irony is that the traders who succeed at the highest level are those who have completely detached their identity from the outcome of any single trade. They do not measure their worth based on accuracy. They do not feel threatened by losses. They do not treat the market like a battlefield where they must prove themselves. Instead, they understand that being right is irrelevant in a probabilistic environment. What matters is consistency, the ability to apply your edge over and over without emotional interference, regardless of the temporary outcomes that occur along the way. Consistency is built on a framework of process rather than prediction. When your focus shifts from needing to be right to being consistent, your decision-making changes dramatically. You stop trying to forecast the exact direction of the next candle and start focusing on whether a setup aligns with your rules. You stop fearing outcomes because outcomes do not define success. You stop expecting perfection and start trusting probabilities. This shift liberates you from mental tension and allows you to trade with clarity and composure. To eliminate the need to be right, you must first acknowledge the emotional cost of maintaining that need. The need to be right creates anxiety before entering a trade because you fear the possibility of being wrong. It creates stress during the trade because you feel responsible for controlling an outcome you cannot control. It creates frustration after the trade because you interpret losses as proof of inadequacy. This emotional cycle drains your energy, erodes confidence, and leads to impulsive decisions. But when you let go of the need to be right, that entire emotional burden disappears. The pressure lifts, the mind relaxes, and your actions become more aligned with logic rather than emotion. Another powerful aspect of eliminating the need to be right is learning to embrace the neutrality of the market. The market does not punish or reward you personally. It simply moves. Every tick, every fluctuation, every reversal is a reflection of collective behavior, not a commentary on your skill. When you take outcomes personally, you create emotional narratives that distort your interpretation of the market. But when you see the market as neutral, you stop attaching emotional significance to wins or losses. You stop interpreting outcomes as personal judgments. This neutrality is essential for developing consistency because it prevents emotional swings from influencing your behavior. Consistency is achieved through discipline, structure, and emotional neutrality. It requires executing your plan the same way every time, regardless of whether the last trade was a win or a loss. It requires sticking to your risk parameters even when you feel tempted to size up. It requires taking valid setups even when you're afraid, and skipping low-quality setups even when you're eager to trade. Consistency is not about flawless performance. It is about repeatable, stable behavior. When your actions become stable, your results become predictable over time, even if individual trades fluctuate unpredictably. They do not fear losses because losses do not define them. They understand losses are simply part of the process, and they treat them with the same neutrality as wins. Letting go of the need to be right also enhances your ability to adapt. When you are committed to consistency rather than correctness, you remain flexible in your thinking. You can shift bias quickly when the market provides new information. You can reverse your position without hesitation when conditions change. You can accept that your analysis was incomplete or your interpretation was off without feeling defeated. This adaptability is crucial because the market is dynamic and rigid thinkers struggle in dynamic environments. Consistent traders thrive because they respond to what is happening, not what they believe should happen. Another crucial aspect of eliminating the need to be right is that it removes ego from the decision-making process. Trading becomes less about proving something and more about executing a method. Ego-driven traders battle the market, trying to force it to validate them. Process-driven traders align with the market, flowing with probabilities instead of resisting them. When ego is removed, humility enters the mindset. Humility allows you to accept uncertainty, respect risk, and follow rules. Humility creates space for learning instead of defensiveness. Humility allows you to grow, evolve, and refine your approach continuously. When you prioritize consistency over being right, you begin to see trading as a long-term game rather than a sequence of isolated events. You understand that one trade means nothing in the context of thousands. You understand that your edge reveals itself over time, not trade by trade. You understand that your job is not to win every battle, but to let the law of large numbers work in your favor. This long-term perspective removes emotional urgency and allows you to operate with patience and stability. The market stops feeling like a test and starts feeling like a process. Letting go of the need to be right shifts your psychological foundation. You become calmer, more deliberate, more focused. Your confidence becomes internal rather than dependent on short-term outcomes. Your decisions become more rational. Your discipline strengthens. Your emotional swings reduce. You start to embody the mindset required for long-term consistency because you no longer place psychological weight on individual results. Every action becomes part of a structured, purposeful process instead of an emotional reaction to uncertainty, aligning your thoughts, emotions, and actions to operate. Like the top 10% of traders is the culmination of deep psychological structure and deliberate internal conditioning. The majority of traders operate from a fragmented internal state, thinking one thing, feeling another, and doing something entirely different. This fragmentation creates inconsistency, confusion, hesitation, and emotional volatility. To rise into the top tier of performers, alignment must become your default internal environment. When your thoughts, emotions, and actions work together instead of against each other, trading becomes fluid, objective, and free from unnecessary psychological conflict. Your thoughts are the cognitive foundation of your trading. They include your beliefs about the market, your expectations, your understanding of your strategy, and the mental models through which you interpret price action. Many traders have conflicting beliefs. They believe in risk management, yet secretly hope to avoid losses altogether. They believe in probabilities, yet expect certainty from every setup. They believe in discipline, yet allow impulses to override their rules. These internal contradictions create cognitive dissonance. When you think one way but act another, the inconsistency generates tension that shows up in your trading decisions. Aligning your thoughts means establishing clear reality-based beliefs about trading. It means internalizing that the market is uncertain, that losses are normal, that probabilities govern outcomes, and that your edge only manifests over a series of trades. These beliefs must become deeply rooted, not just intellectually understood. When your thoughts are aligned with how the market truly works, your perception becomes stable and objective. Your emotions are the energetic force driving your behavior. They amplify your thoughts and influence your interpretation of market information. Most traders try to suppress their emotions, believing emotions are the enemy of good trading. But emotions are not the problem. Misaligned emotions are. Fear, greed, excitement, frustration, and impatience arise when your emotional expectations conflict with market reality. For example, fear emerges when you risk more than you're comfortable with, when you are attached to being right, or when you don't trust your ability to handle losses. Greed emerges when you feel the need to accelerate results too quickly, or when your ego is tied to outcomes. Emotional alignment means cultivating emotional neutrality, experiencing the market without emotional distortion. It means feeling calm in uncertainty, confident in execution, and detached from short-term outcomes. Emotional alignment emerges when your beliefs support a probabilistic mindset and your risk parameters support psychological comfort. When emotions no longer conflict with your thoughts, you stop experiencing internal resistance during execution. Your actions are the visible expression of your thoughts and emotions. They are the measurable behavior that produces your long-term trading results. Many traders know what to do but fail to act accordingly. They understand their strategy but don't follow it. They have rules but break them. They see a valid setup but hesitate. They know they should cut a loss but hold anyway. These breakdowns in execution occur when thoughts and emotions are misaligned. When your actions contradict your internal intentions, you create habits that destroy consistency. Aligning your actions means executing your plan exactly as it was designed, with no interference from emotional impulses. It means becoming reliable to yourself, someone who follows through on their own commitments. When your actions become consistent, your edge finally has the opportunity to express itself in your results. Alignment begins with self-awareness, the ability to observe your internal state without judgment. Most traders lack this because they are too focused on the market and not focused enough on themselves. To operate like the top 10%, you must study your own mind with the same precision you study charts. Identify thoughts that contradict your trading principles. Identify emotions that arise during uncertainty. Identify actions that stray from your rules. Awareness exposes the gaps between how you think, feel, and act. Once identified, these gaps can be closed through deliberate mental restructuring. Aligning thoughts requires replacing conflicting beliefs with supportive ones. If you intellectually understand probabilities but emotionally crave certainty, your thoughts are not aligned. If you know losses are normal but feel threatened by them, alignment is missing. Developing supportive beliefs involves repetition, reflection, and reinforcing experiences that validate those beliefs. When your thoughts fully accept the realities of trading, clarity becomes your baseline. Aligning emotions requires addressing the root causes of emotional discomfort. Fear, for example, often arises from risking too much, lacking trust in your system, or attaching self-worth to outcomes. Greed arises when you try to compensate for insecurity or impatience. Emotional alignment requires adjusting your risk to emotionally sustainable levels, detaching identity from performance, and internalizing the neutral nature of the market. When your emotional responses align with your trading principles, you experience calmness even in volatile conditions. Aligning actions requires discipline and repetition. You must train yourself to act according to your intended process rather than reacting impulsively. Consistency in action is not developed by willpower alone. It is built by practicing execution in a structured, deliberate way. With enough repetition, desired behaviors become automatic, reducing the influence of emotional noise. Aligned actions flow naturally because they emerge from aligned thoughts and aligned emotions. When thoughts, emotions, and actions are aligned, your internal environment becomes frictionless. You are no longer battling yourself during trades. You no longer hesitate between conflicting impulses. You no longer struggle to follow rules or manage risk. The market no longer feels threatening because you are no longer interpreting it through emotional filters. You begin to operate from a state of psychological coherence, where your internal state matches the demands of consistent performance. Alignment also creates a sense of inner stability that the top 10% rely on. This stability allows you to remain unaffected by short-term fluctuations, drawdowns, or individual losses. You stop seeking the market's validation because your confidence comes from internal structure rather than external outcomes. You stop experiencing the emotional turbulence that causes most traders to spiral during losing streaks. You operate with trust. Trust in your process, trust in your discipline, and trust in your ability to execute regardless of uncertainty. Another powerful effect of alignment is the development of flow. Flow is a state where actions become effortless, decisions become intuitive, and execution becomes seamless. You are fully present, emotionally neutral, and mentally clear. You respond to market information without hesitation or internal conflict. Flow is often misunderstood as instinct, but it is actually the natural result of internal alignment. When the mind is free of contradictions, it enters a state of fluid responsiveness. This is how elite traders operate: decisive, calm, adaptive, and consistent. Finally, alignment positions you to grow continuously. When your thoughts are open, your emotions are stable, and your actions are consistent, you can refine your method without resistance. You can adapt to changing market conditions without emotional disruption. You can learn from mistakes without self-criticism. You can evolve your strategy with clarity because you are not trapped in psychological patterns that sabotage progress. Alignment becomes the foundation for long-term mastery, allowing you to operate not just as a trader, but as a disciplined, self-directed performer capable of sustaining success over a lifetime.